Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Tuesday, August 29th, 2023. It's 9:53 a.m. Eastern Time, so I'm getting this one out, and I'll keep it relatively simple and relatively short. Here's what we're going to do in this order. Take a look at the major stock indices, then what's been referred to over the last year as the Magnificent Seven. The old fangs have morphed into really, seven stocks that have done almost all the heavy lifting in the first 3 quarters of 2023, or at least the first half. And then we'll look at the other two things that I believe will directly impact or are correlated with the stock market to a greater or lesser degree, and that'll be Treasury bonds, i.e. interest rates, really longer-term rates, and the euro and US dollar. So, all right, sounds like a lot, but it's not. Well, let's start here. I won't go over a gazillion time frames, but start out here with probably the most significant, and that's the daily time frame. So on QQQ, typically my index of choice for trading, because it's simple. When the stock market is going up, the major trends, even the swing trends, you're going to get more bang for your buck 9 times out of 10, if not more. If you get the call on the direction of the market correct, you're going to have more upside in QQQ. Likewise, if you're shorting, it tends to fall more on the downside than the S&P 500. And that's simply because this is more concentrated in growth stocks and very little steady Eddie dividend paying blue chips that kind of offset and all the diversity you get in the S&P. All right. So the levels to watch on the daily chart, and one reason I've cut back on videos the last couple of days is this: we're going nowhere. We're bouncing around in a tight range. So there's, for me to sit there and pump out videos, and it's just a waste of everybody's time when the market's going nowhere. However, I do these because you need to know the levels to watch, because all of a sudden the way this game works is you get these little periods of consolidation, the market goes nowhere, and everybody just kind of starts to fall asleep, or active traders get frustrated. No, swing traders especially. Active traders can bounce. If you're a very active trader, you can bounce around, get 1-2% trading the 5-minute charts, 15-minute charts. And then finally, when you have a area of consolidation, a breakout usually sparks the next trend, whether it's to the upside or downside. So this one's a kind of a sloppier when you look level. But once again, let me just highlight the key levels to watch that I believe will be significant if and when taken out, and that's the primary uptrend line that comes off the early January lows. We have clean reactions here, a couple lately, and so I'm still looking for and favoring a breakdown below that level. But unless that happens, as I like to say, support is support until it's broken. So, and I'm going to go over some things to watch that could let us hold that level. Now, keep in mind, just below it, I'm going to turn these lines off in a second, and then we're going to focus on moving averages. You also have the level I've been harping on for a couple weeks now, big level in my opinion, about 357.60, and that is what I call my BOD, or benefit of the doubt support level, because it's significant support and it lies just a hair below the trend line. So let's say the trend line goes this week or next, for example, it's we're talking probably less than 1% below, but that's a level that could come in and lead to a whipsaw, let's say, if the buyers step in and buy 357.60. And I also believe it'll be, actually, that's the level I had, though this is the red line. I'm sorry, I'm highlighting 357.60. It was, and still is, in my opinion, very important level. But this is the one that I've been harping on for weeks, is the one to add to or go aggressively short, I believe, if it's taken out, and that's 354.70, that red line. That's what I have, and that's the level I've been talking about, the low from Friday before last right there, and I think that's kind of lights out, because when that goes, you'll have taken out the trend line and 357.60. So those are the levels to watch below from the daily time frame. I gave you more micro levels, if you will, yesterday on the NQ 15-minute chart. And then on the upside, there are certainly other levels, but the two big ones to me are marked here, 370 to about 372.85, and the downtrend line off the highs right there. So that together, these two lines, the uptrend and downtrend line, form a symmetrical triangle. And the way it works, these are recognized, known patterns in trading. They can break either way. They will break either way. It's going to break one way or the other soon. You're getting to the apex, so it has to break out. It can't continue forever because the apex is right here, and then the triangle ends. So, and these things usually don't break at the apex. They don't make it that far. It's in the sweet spot now where these patterns typically break out. So, again, at the risk of oversimplifying things, because that's what I'd be doing if I said an upside break will most likely give you a pop to new highs. I still think, again, that's what I'm going to say. We'll just say that it will significantly increase the odds if you break above that trend line, and if that breakout sticks. Anything more than just a brief whipsaw intraday or even a one-day pop and then drop below. And then the takeaway is, if that's confusing, what do? Take it on face value. If you are, especially if you're bullish and you think this market's going to new highs, take the breakout and then just have your stops where you want them. You could have it if it fell back within the triangle. You could have a stop if it went down below the triangle. That would be very bearish. A false breakout and then a break to the downside. That would be a big whipsaw. So in that, likewise, if you're bearish, you can short these resistance levels. I keep giving you levels in a bearish trend, which we have been. Make no mistake about it. The longer term trend off the January lows in the NASDAQ is bullish, but then intermediate or shorter term, however you want to define it, since July 19th, that's clearly a downtrend. Nobody can argue that. There's your highs, right? And lower lows, which is the definition of a downtrend. When does that downtrend start to get called into question? When we start taking out these previous reaction highs. So that's what it is right now. And as such, you need to define or figure out where you think the market's going, because at least that's how I trade. It helps formulate a strategy. Is if you believe the downtrend is going to continue, then you want to continue to look to short rallies into resistance. If you're bullish and you think the downtrend is likely over, because if you want to zoom down to a very near term, you go to a 5-minute chart, and then you can see the very, very near term downtrend just since in the last few days is currently bullish. You have a series of higher highs here, and so far by this one, if you look at just maybe let's say that reaction low, this reaction high, then a low. So if we do this, now you have the makings of a very near-term uptrend. So again, it's all relative to the time frame you're looking at. But if you are, most people don't do that. I get this. I've done this long enough that I don't get a lot of feedback, or hey, I did, thanks for that quick 2% trade in the 5-minute charts, made a few bucks. So I realize that I'm, sometimes share my active trading stuff, but most people that are, listening to my voice right now are typical swing traders, trend traders, or investors. And these are the bigger picture levels. So consider it pretty much noise as long as we're in this triangle. And then I think that's where the party gets started. And that's the risk of oversimplifying things, because at the very same time, I want to see what the S&P 500 is doing, what Apple, Microsoft, and the rest of the Magnificent Seven are doing, and I'll get to those in 1 second. So that's it. There are my levels. And this chart has been shared recently, so you can reference it. If you go back into some of the recent posts, I should have something up like this, or just screenshot this, replicate it if that's your thing. Now let me turn off all the trend lines, and let's just look at the moving averages here. So what I've done today for this video, I told you that I usually keep up the 50-day exponential moving average on my daily charts. And however, I've acknowledged that a lot of traders use a simple moving average. So that's what I've added here in purple, this purple line. And I always keep up both the 200 exponential and the 200-day simple as well. They're way down here, so let's not even talk on those now. There's been a lot of talk about the 50s, so we're going to go through that real quick here. And then I have this one. It's always been on the board. I usually have it turned down. You don't see it. I just changed the color today to let it stand out. That's a 28-day EMA. So we're going to go through the big stocks right now, where they are in relation to that. So QQQ has been slicing through the 50s. But so far, the 50-day simple has capped. Since we moved down, they came in together here. That's where the simple and exponential cross there. The exponential just moves or responds a little faster to price due to the calculation methodology. And so You can see right now those traders looking at the 50 simple see QQQ is still below it, and so that's where you may get some sellers stepping in. We're about to hit it right now. I'll zoom in for you here. You can see it. There it is. So we had that intraday pierce followed by a pretty hard rejection. And again, we've been slicing through the exponential, and so you don't, these aren't all in, hard or none, long or short when you're above or below it. It's more of a, okay, we're testing the 50s, right? And when you clearly start to move away from them, they tend to help define the trend. So when you take them out, you took them out back here earlier in the year, and then you've remained above them, and that's been bullish. And then we cross below them. So right now, when you cross below, and you start to get away from them as we did, this I'm viewing simply as a back test as of now. We regain them, we start to move away from them, then that means this right here was simply a whipsaw. It was a breakdown. We did get below all of them, but it'll prove to be a whipsaw, and that will also most likely be a further additional technical catalyst to support that case that we're going to run at new highs. Put in the whole divergent high, marginal new high scenario, which I can almost flip a coin on right now, really where I think things are going. So you got it from my post this morning. I don't have strong convictions on the very near term because the charts just aren't clear. We have a potential bullish PPO crossover there. We're coming off near oversold levels down here on the RSI. So there's plenty to be made on either case right now. And my job isn't to sit here and give you wishy-washy analysis. If that's what you view it as, that's just the way I am. I won't aggressively engage the market or any stock when I can sit there and make a pretty decent bullish or bearish case. I've been very clear. These are the levels that that I think will be significant. And like I said, anything between there is just noise. So. All right, that's a pretty exhaustive analysis on QQQ. Let's just look at the others. Here's Apple. Apple clearly broke down here, and whether that was the end of the run or not, this drop off after the breakdown and backtest of the primary trend line. Let's just turn off the price levels and look at the moving averages. So here's Apple. There's the 50 and the 28, the 50-day exponential and the 28-day exponential moving averages. The 28 I like, it does a really good job at times. I'll use any moving average. I'm not married to any one. And what I can tell you from experience, different securities, different indexes will respond to different moving averages. There's not a one-size-fits-all. So I like to look at which one, and most importantly, they will respond to different moving averages, meaning act as support and resistance when they fall to it or rally up to it, but also in different market conditions. So there are times where you're consolidating, chopping around. You're going to go through the key moving averages like they're not even there. And if you sit there and try to say, okay, I'm long above the 50 and then I'm short above, you're going to get whipsawed to hell. And the only person making money there is your broker. So they're great to use moving averages during a clear trend. So this is a bullish trend. You can see pullbacks to the 28 have been getting bought all along since we took it out back here. And we went through it. We took out the 28 in green there. We took out both 50s. That's where the 50, you can see how well the 50 exponential and simple moving average were right on top of each other, and in one fell swoop on that gap down, Apple took them out. So there it is. You're back testing one of the 50 simple, the 28 exponential with the 50, or there's a 50 simple, I'm sorry. So you're doing the 50 exponential, right? It moves faster. So bottom line is this is the king of the Magnificent Seven, as I call them, and this one is below all of the key moving averages right now. Yep, bullish crossover there, coming off oversold conditions. Last time Apple was this oversold was right here, but remember, this was also after a very healthy drop right there, and there was positive divergence on the daily chart. A lot of reasons to go long, and I was long, harping on this one as my, in the beginning of the year, one of my top picks on the long side as an overweight. So there it is. So yeah, a lot to be taken here. You can make a bull case, you can make a bear case, but if based on the longer term charts and my outlook, that's where I opt to recognize these things, but I'm still leaning towards this being the most likely scenario for Apple. Because if you buy, if my read on the market's correct, that's a big if, and this was a significant top and we're going much lower, then what happens is oversold doesn't work that well. It works great in a bull trend or at the bottom of a correction or bear market. But once you get going and the market's dropping, and you can go back here and see a lot of oversold periods where if you bought Apple, there's one right there that the stock went on to make another low, maybe had a rally from there, but had another big leg down to come. So anyways, I just wanted to point out the technical posture, particularly with the confluence of moving averages above on Apple. Microsoft. From a price perspective, this is one of the uptrend lines I have here. It's not my favorite. I'm going to say it now. I've been saying that all along on Microsoft. I've had several trend lines. None of them were super well defined. They were just kind of, But this is a pretty significant level. We've chopped through it a little bit here, but I see enough reactions. There was this little consolidation area here, and we had a false breakout to the upside. So let's turn off price levels. I just want to say that it's been sloppy kind of slicing through here, and I study this chart every single day. I look at these big market leaders, and I just don't have any great horizontal price support levels or resistance levels. The ones that I think are significant are there, and then the trend line. So let's just study the MAs real quick, and you can see the same thing here. These are the MAs after that choppiness and kind of bottoming. Remember, the stock market bottomed in mid-October, but the vast majority of the things, most of the Magnificent Seven, didn't bottom until right in the beginning of the year there. And so once they did, and they took out the confluence of those three MAs, moving averages that I've been focused on here, you can see they acted as excellent support levels on pullbacks. They showed you that the trend was bullish, and pullbacks to those levels got bought. And then right here, you took them all out. You traded clearly below them. And so this is simply a back test. You can see there, we rallied up one day. The highest one we hit was the 50 simple, the slowest of those three moving averages right there, got rejected. But these guys have done a good job too, the exponential 50 and the 28. And you can see we're sitting below there. So what I'm showing you is from these moving average perspective, especially we're just below some pretty key levels, and these are talked about. This is not just me. 50s have been around forever. The 50s, the 200s, the 100s, those are your big moving averages, and a lot of traders and algos will trade off those levels. And again, it's considered bullish when the stock market or an index is above them, and bearish when it's below them, and ditto for these market leading stocks. Next up, Alphabet, GOOGL. That one's actually above them all. That's one that I've been saying lately is hanging in there, and I need this one to go. We've had X's or check marks on breakdowns for Apple, most of them, but Alphabet's holding up as far as the Magnificent Seven go. Pretty much Alphabet and NVIDIA are the only two, in my opinion, and they need to buckle. So there was some talk the other day. Somebody asked me about bearish engulfing candles on the indexes, and I said yeah, they were there, but it doesn't matter to me. I only look at those. That was it right there. I think SPY had one too. There's QQQ. And my reply is that those, you look for those as bottoming or topping sticks, so they have to come at the very end. They need to be the highest candle after a prolonged uptrend, or at the bottom on a downtrend, just like we had these giant bullish engulfings back here. Those are topping and bottoming candles. Otherwise, if they come in the middle of a trend, you're going to find them everywhere, and they usually don't mean that much. So back to Alphabet, however, Alphabet did have one, and that was so far the highs. Now, the thing is, to be a topping candle, by definition, it has to be the highest candle. And so we're getting close. We're pushing the upper limits of it. Not the end of the world if we go above it, because you're still going to have the same divergence that's been building, and I've been talking about. This chart, I can just say it this way. If I had to go long or short, somebody gave me here's 100 grand. You can either go long or short Alphabet. You have to go one or the other, and you have to wait, 6 months before you cash your position out. Hands down, I would short it. We don't have the sell signals yet, so, wait. This is the sell signal. This is the uptrend line that defines this big giant bearish rising wedge complete with negative divergence, and whether we continue on up, make that marginal new high scenario in the markets, because if we do, Alphabet will most likely go along with it, and it's simply going to just move the line a little bit. Just like in football, you get a first down, they move they pick up the first down markers, and they move them, and you got another 10 yards to go, to move them again. And so that's the same thing. We'll move these lines until they're gone, and they're not anywhere close to being gone anytime soon. So I just want to point that out. So for now, very near term, watch that. And then again, turn off all the lines, forget about price. These are, you have that confluence. You can see how these moving averages are just doing a heck of a job acting as support and telling you this one hasn't buckled yet. This one is clearly, by every single metric out there, in an uptrend. It's above its key moving averages, the shorter term, the faster moving averages. Later on, we'll be talking at some point, whether it's weeks from now or months from now or a year from now, we'll be talking about the 200 days as big levels. But right now we're so far above those. This is what we're focusing on, and this is what the market's watching. So there's Alphabet still needs to they need to put a stake through its heart, the bears do, or the market's not going to roll over. Amazon's busy chart here, but you can see where I have this trend line. It's an okay but not a great uptrend line. It's decent. You have 1, 2 reactions there, 3 reactions there, 1, 2, 3, several candles, and we broke, and we're back testing if you zoom in real closely. But let's just turn off the price levels, and you can see the same story here. Look at all these key moving averages, which have been acting as support all along. We're right on there. So it's another one that by that definition, still, this is simply a pullback to support. You can buy it if you're bull. No reason not to if that's your outlook, with stops somewhat below, because they're all on this one. They're all close together. I mean, if you bought it here, you have the lowest of them all is about 2.3% below current levels. That's just, it doesn't get much better than that. Normally, I don't run stops that tight on swing and trend positions, but you could do that, because if that gets taken out, you've taken out a lot of levels. You've taken out these 2 lows that came in together. You've taken out all the MAs. But again, do it all together. What I mean by that, look at all the big, Magnificent 7, look at all the indexes. Because if Amazon did pop there, but then at the same time, Apple, Microsoft, Alphabet, NVIDIA, Tesla, they're all holding support or breaking out to the upside, that would probably be a whipsaw. These guys all move together because of the indexing and just kind of the herd mentality, really, too. All right, so NVIDIA up next. Okay, so you're getting the story. We're almost done. We have 2 more to go. There it is. There's all your MAs. I won't just keep harping on it. You can see, especially this 28 days, really done a good job there. And that one, we're above them all right now. So we just had a pull back to them. And so far, we're above all those moving averages. And so that needs to go for NVIDIA, as well as from a price perspective. I've highlighted my levels for a while now. First big one, 403.30, then 375. And that would take you most likely back to the uptrend line here. And then that's something we're looking at later on. We don't even have any sell signals yet. We're just off the highs there. And it's a big divergent high. It tells me we're going down there sooner than later. It's still, to me, a matter of, we're going to make a marginal new high in reverse, which is, slight in percent, slight in relative terms, or not. I haven't waffled on anything much more than that. The divergences get taken out. If we, the market goes up, 8-10% or more above the previous highs, then I'm just outright wrong on everything. So then I'll be, hopefully making money on natural gas and gold and crude oil and everything else, that's out there, and individual stocks too. Okay, 2 more to go. Tesla, big levels are the primary downtrend line, which I mentioned when we hit it recently. We were coming up to it, and I said that would be a magnet, a great target, and we hit it to the button. I mentioned that as a very objective short entry. And if you shorted that rally into the bear market downtrend line, from high to low, you made almost 30% on that. That's how much it dropped. Where it's at now, I don't have a strong opinion on this one. You can see that it's actually been a little sloppier. Tesla has such a high beta. It moves so much during corrections. It tends to fall more than the rest of the Magnificent Seven, and it tends to rally more. And as such, it's cut through these. But overall, it's done a pretty good job. It lost them all there. I'm talking about the 28 and the 50s. Stayed below them. They were resistant, especially that 28 in green there, right? And right now, it undercut them, and we're back testing the 28 and the 50, the 28 exponential and 50 simple with the 50. There's the 50 simple right there. So it's the 28 in 50-day exponentials we're back testing now. So yeah, I don't have a strong opinion on it right now, but I'm just pointing out resistance levels that, if taken out, are going to be bullish, and if rejected off of, that's going to be bearish. And then finally, there's Meta. Meta took them all out here, and it's remained above, and that 28's done a really good job. It was a strong uptrend, so the fastest of the moving averages that I'm using here was the one that they were buying up. And look, we took them all out recently. There was the breakdown. Back tested it. Remember, so let's focus on that 28 or the highest ones, and we're below. We're below all of them right now. So this one I have a check mark for the bearish case. So that's it. I spent a lot of time doing this because these stocks are the market. And the Magnificent Seven, when they all die, not one or two, they all need to die, meaning move below these levels, then that's where, in my opinion, at least me, I'll get more aggressively short for swing trend positions. And we have, by the way, majority of them are below. We just need a couple more. Mainly, I need to see NVIDIA and Alphabet die. And then, there's my targets. These haven't changed on Meta. T1, T2, T3, and then this potential T4 and 5. So as of now, this one is an objective short. It's below, it broke down below the primary trend line. It's below all these moving averages. It's right on that 290.20 support right there. However, to take a shot at it now on a short, I wouldn't go all in or heavy full position, because like I said, if the others don't break down, then the Qs and all these other, Magnificent Seven or whatever you want to call them are only going to go so far, so fast. So there it is. And then I told you we'd look quickly at Treasury bonds because interest rates are certainly a significant factor. IEF showed you that this, despite the downtrend in bonds, which means yields have been rising, and that's what everyone's been talking about lately. That's what put pressure on the stocks, the stock market in the last couple months or month or so. But like I said, this was a bullish chart, and I'm still long the 10-year and 30-year as both pure play hedges on a constructive chart, positive divergences, everything else. There's IEF, TLT is the 30-year. You can see beautiful little bullish falling wedge, complete with positive divergence. And they're not moving up strong, but they are moving up. And that also means yields are falling, and that's bullish for stocks. So there's another reason to be cautious and something that helps support that case that we could see that marginal new high. If these charts play out and we continue to see bond prices rising, which means yields falling, that should be a net positive for the stock market, unless this occurs because the stock market's melting down. That is always one potential there. All right, and these are for you, for those of you that trade futures like I do. This is the ZN. So there was the buy signal. It was a beautiful little 60-minute wedge break. Again, this was highlighted a couple weeks back. And it's not rocketing, but it's moving up now. It's pretty much at my first price target right now, that 110.052. And then you can see the other levels. The only thing I've added since I got this chart out to you, the first iteration of it a couple weeks ago, is I've added a potential downtrend line there. We don't have a third confirming reaction yet, but this is probably where we're going there. And if we do, that's probably going to mean that the equity markets, that should be a net positive for the equity markets. And there's ZB. This is the 30-year bond futures. And so what this means is, and again, it was in the charts. There's a breakout. It's been moving up. another break of the downtrend line. This was a decent 1, 2, 3, 4 reactions, 5 right here, and now a breakout. So as I'm doing this video, this is still an objective entry point, and it's also a reason to maybe, if you're still short, lower some stops on those short positions, because this is going to spark a rally if you continue to see bond prices fall, which means, bond prices rise, which means bond yields are falling. There's TNX. Everybody watches the 10-year. The pros do. 10-year Treasury bond is more closely, mortgage rates track. The 30-year mortgage rates more closely track the 10-year bond than they do the 30-year. So this is what everyone watches. And there it is. So, you had that negative divergence on yields. This is where everyone was saying, oh, no, yields are going up. And they were, and that was putting pressure on the stock market. That's why we were short. But now with yields falling and looking like they're going to fall at least a little bit more, at least. And then don't forget, I've given you the long-term outlook. There's a primary trend line here that could bring yields down a whole lot lower. This trend line comes all the way back from, where is that? Roll back, excuse me, all the way back to the COVID lows. And it's a pretty well-defined trend line. And so, if that breaks, that's going to bring yields down. And again, it should be a net bullish 100%, unless it's because stock market's melting down or moving down impulsively. Falling yields is a net positive for the equity markets in every way, shape, or form. Lowers the cost of capital, lowers the cost of alternatives. I've talked about that. Those are the two reasons that interest rates are everything to the stock market, especially when they start to reach these thresholds. When they're in, in the middle of, what I call extremes, it doesn't make a difference. But the market has showed us, this is a level where you're pushing on a string or hitting a point where it really starts to matter. This is where everyone was shrugging off, oh, interest rates, this economy's so strong, it can absorb them. Yeah, it can absorb them up to about this point now. The market showed us that the stock market starts to throw a hissy fit when we get up here. So that's going to be bearish for the stock market, whereas this would be a net positive. All of a sudden, if this happens, CD rates are going to start falling, bond rates are falling, and then all of a sudden, dividend-paying stocks, even though there's more risk involved, look more attractive. But when you start to get 5 and then 6, 7, 8% on CDs, I promise you money is going to get siphoned out of the stock market if that's the case. If you go to, from these 5% CDs and Treasury bonds, or near 5, up to, and banks, a lot of banks have been paying over 5% on money markets and CDs lately. All right, guys, that's it. Those are the levels to watch. Last but not least, yes, the euro. I've talked about this many, many times over the years, especially in recent years, because there's been a pretty strong correlation. It's disconnected a little bit lately. It's something I've showed you many times. I'll show you again before we wrap this video up for those of you new. But there's been an inverse correlation between the U.S. dollar, meaning the dollar goes down, and the stock market, which goes up. And that's the same thing as saying a positive correlation between the euro and the stock market, because the euro moves inversely to the dollar because it's the biggest component by far of the dollar index. So basically, euro up means dollar down. And so that's why I like to flip things. It's easier when you flip things to a positive correlation. It lets people see there's FXE, which is the euro ETF. And if you compare it to, let's turn off all the lines here and compare it to the stock market, just to confirm here. It is very clear. They move in, and for the last couple of years have been moving in almost perfect lockstep. Even the little corrections along the way, you get the corrections, the zigs and zags, especially the primary trends moving up. You get a little bit of a lead time here, right here. The euro peaked after the market, but then you can see once the market got the message, they were both moving down. They both bottomed right here, and they were both moving up. Even these little corrective waves, so you can see that correlation. Remember, the lines aren't going to overlay each other because they're priced differently. Currencies move in much, much, much smaller increments than the market. So you want to look at the overall trend. Are they both going up and down? And, here it is. So recently the euro was dropping, the market dropped. Now the euro is starting to, the euro is down here. This is the stock market. Stock market's starting to go up. So either the euro is going to follow and confirm this turn. The market's anticipating a turn here. So let's look at that. Let me turn off the comparisons, go back, analyze the chart of euro, and I will wrap this up. So I like to use this one because it shows around the clock trading. Turn on all the levels. Bigger picture says most likely put in a big divergent high, it's going lower. However, you can see what I circled here. Nothing goes down forever. So I try to speak in time frames. I'm making, longer term bearish on it. However, if you look down here at the very bottom, you can see simple stuff, right? We were oversold here, right here. Last time we were oversold, that's a 30 level, the blue line on the RSI down below right there, right? Let's just circle those, and then you can see why there's, the stock market, even though the euro hasn't bounced much, the market's bouncing a little bit. This was a very, very close, just a hair above, but it's still marked about the bottom. It didn't go any lower, it didn't start rallying. Well, it has started to rally and came back, checked that level for a few times. So it's about, you're looking at this chart, a damn near 100% effective rate. Not the day of those oversold readings, sometimes the day of, sometimes it's one and done. But usually if you didn't bottom then, that was it for the euro. It didn't go any lower. It might have taken a week or so to play out. But again, you can do this yourself, circle these. All the better when you get positive divergence, then it's that second tag that marks the bottom. But even that first tag right there, you had a bounce right there. You can see oversold. So, okay, this is, I hate to say it, it's simple stuff. It's not 100% effective. You can't bet the farm every time, but you get that. So, and that would be, again, help support the case for a rally. So there it is, guys. Since in the last week or so, I see, additional, an additional case or more check marks starting to form for the rally. I've talked about this divergence in the euro. This is a 60-minute chart I jumped down to. It's been just going, extending, but it's not been negated or taken out. We've had positive divergence building on the 60-minute chart going back to here, and each one had a little rally in it, and then we just made a new low rally, but the divergence kept building. And so now if this takes off, that's going to support the case for a rally in the stock market and gold and silver, which I threw out as alongside trade ideas recently too. All right, guys, let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.